Welcome to our deep dive on what to do with a $10,000 windfall. Today we will explore whether you should invest it all at once or spread it out over time, and we will build a practical plan that balances math with mindset. To set the stage, we will begin with the agenda so you know exactly what's coming. Next, let's outline our roadmap. Here is the agenda. First, we will frame the context and define the central choice. Second, we will give a quick disclaimer. Third, we will compare lump sum investing and dollar-cost averaging using research and practical considerations. Fourth, we will walk through a decision framework with visuals. Fifth, we will cover the emergency fund and the order of accounts. Sixth, we will execute a clear action plan. Seventh, we will discuss fund selection and pitfalls. Eighth, we will test your understanding with quick quizzes. Finally, we will summarize key takeaways. Now, with the plan clear, let's move into the context. You have received $10,000 and already used tax-advantaged accounts like a 401k and Roth IRA. The central decision is not whether to invest, but how quickly to put the money to work. This leads to the classic debate between lump sum investing and dollar-cost averaging. With that in mind, we should briefly clarify important boundaries and disclaimers. Next, let's cover the disclaimer. This content is for education only and not financial advice. Your specific circumstances, tax situation, risk tolerance, and time horizon may change what is optimal for you. Consider consulting a licensed professional before making major decisions. With expectations set, let's now examine lump sum investing versus dollar-cost averaging. Let's define the two strategies. Lump sum investing means putting the entire $10,000 into your chosen investments right away. Dollar-cost averaging means spreading the purchases over a period, such as weekly installments, to reduce the impact of short-term volatility. Historically, research indicates that lump sum investing beats dollar-cost averaging roughly 2/3 of the time because markets generally trend upward over long horizons. The cost of waiting in cash is missed market exposure. However, behavior drives outcomes. If a sudden drop after investing would cause you to sell at a loss, spreading purchases can help you stay invested during turbulence. A practical rule of thumb is this. If you will stick with the plan through volatility, lump sum often makes sense. If volatility would cause stress or a plan breakdown, dollar-cost averaging is a sound behavioral choice. Now, to make this more concrete, let's compare the two side by side. On the left, lump sum investing maximizes time in the market, has a historical edge in performance, and is operationally simple. Its trade-offs include the risk of an immediate drawdown and the need for stronger risk tolerance. On the right, dollar-cost averaging smooths the entry experience, reduces regret, and supports behavioral discipline during volatile periods. Its trade-offs include a higher likelihood of underperforming lump sum over time and the complexity of managing a schedule. With the comparison in mind, let's formalize a decision framework to choose between them. This decision flow starts with the $10,000 windfall. The first gate checks whether you have a 3 to 6 month emergency fund. If not, the path directs you to build that fund in a high-yield savings account before investing. If you do have the emergency fund, the next gate tests your comfort with a potential near-term drawdown of about 10%. If you are comfortable with that risk and can stick with the plan, the flow leads to lump sum investing in broad, low-cost index funds. If not, it guides you toward dollar-cost averaging with a defined weekly or monthly schedule into the same type of funds. Throughout, there is a reminder to check whether you have remaining contribution room in a Roth IRA before using a taxable brokerage account. Next, let's zoom in on the emergency fund step. Before investing the windfall, ensure you have 3 to 6 months of essential expenses in a liquid, high-yield savings account. The purpose is to avoid selling your investments at a bad time if an unexpected expense occurs. Choose an account with appropriate insurance where applicable and easy access. Automate deposits until you hit your target. With the safety net in place, we can now prioritize the accounts to invest in. Here is the step-by-step plan. First, verify your emergency fund is complete. Second, check how much contribution room remains in your Roth IRA for the current year, subject to annual limits and eligibility rules. Third, if you are eligible and have room, consider directing the windfall into the Roth IRA to benefit from long-term tax-free growth. Fourth, if your tax-advantaged accounts are already maxed out, use a taxable brokerage account. Fifth, select broad, low-cost index funds that capture the total market exposure. Sixth, choose your entry method. Use lump sum if you can tolerate short-term volatility, or use dollar cost averaging if volatility would cause stress. 7th, automate contributions and maintain discipline during market fluctuations. With the steps laid out, let's organize the account priority in a quick table. This table shows the order of priorities. Maintain the emergency fund for stability and liquidity. Next, the Roth IRA is prioritized for its potential tax-free growth on qualified withdrawals. Workplace plans like a 401k can be very attractive, especially if there is an employer match, and the tax treatment depends on whether contributions are pre-tax or Roth. Finally, a taxable brokerage account offers flexibility and accessibility, but requires tax management. With the account order established, let's discuss how you might allocate across asset classes at a high level. This pie chart shows an illustrative allocation of 80% stocks and 20% bonds. The equity portion can be implemented with global or total market index funds, while the bond allocation can be a broad investment-grade bond index. This is just an example to show the concept and is not personalized advice. Allocation should reflect your risk tolerance, time horizon, and overall financial plan. With allocation in mind, let's choose specific types of funds to consider. When selecting investments, prefer broad, low-cost index funds that capture either the total United States market, total international market, or a global total market. Keep an eye on expense ratios and avoid layering on complexity. Avoid chasing hot themes, trying to time entries and exits, or betting heavily on single stocks. In taxable accounts, consider tax efficiency by using broad equity ETFs and placing certain bond holdings carefully depending on your tax bracket. Rebalance gradually using new contributions rather than frequent trades. Now that we have strategy and implementation, let's test your understanding with a quick quiz. Question: which approach has historically outperformed about 67% of the time over long horizons? Options are 1. Lump sum investing, 2. Dollar cost averaging, 3. Market timing based on headlines, 4. Putting cash under the mattress. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is lump sum investing. Historically, because markets tend to rise over time, being invested earlier has an edge. However, personal behavior and comfort with volatility remain critical. Now let's reinforce the foundation with a second quick question. Question: what should you generally insure before investing a windfall? Options are 1. A fully funded emergency fund, 2. Buying single hot stocks first, 3. Choosing the most expensive active fund, 4. Taking on leverage immediately. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is a fully funded emergency fund. This safety net reduces the likelihood of selling investments at an inopportune time to cover unexpected expenses. With that confirmed, let's visualize a dollar cost averaging timeline for those who prefer to spread entries. This timeline illustrates a potential dollar cost averaging plan. For example, you could invest $1,000 each week over 10 weeks, or alternatively, $2,000 monthly over 5 months. Each contribution goes into the same chosen broad, low-cost index fund. Automating this schedule helps reduce friction and emotional decision-making. With the mechanics in place, let's crystallize the most important takeaways. Here are the key takeaways. Maintain a 3 to 6 month emergency fund before investing. If you can tolerate volatility, lump sum investing is statistically favored. If volatility would cause stress, dollar cost averaging is a reasonable behavioral solution. Prioritize tax-advantaged accounts, such as a Roth IRA, if you have eligibility and room before using a taxable account. Use broad, low-cost index funds and avoid timing and concentrated bets. Automate your plan, rebalance primarily with contributions, and stay the course. To wrap up, let's summarize. In summary, the core choice is how quickly to deploy the $10,000. Begin with a solid emergency fund. Next, look to tax-advantaged contributions, such as the Roth IRA if you have room. Otherwise, deploy to a diversified taxable account. Choose lump sum if you can emotionally handle short-term declines, or use dollar cost averaging if it helps you stay invested. Keep things simple with broad, low-cost index funds, automation, and discipline. Finally, let's close with a quick message and call to action. Thank you for watching. If this video clarified your plan for a $10,000 windfall, please like the video, share it with someone who might benefit, and subscribe for future content. Share your experiences with lump sum versus dollar cost averaging in the comments so others can learn from your perspective. See you in the next one.